Thank you everyone for being here with us today as we conduct a review on the key market events in Q3 this year. My name is Elson Goh, Head of Asia Portfolio Management in St. James's Place, Singapore. This session is going to provide you with a high-level summary of the markets globally, and we hope that it will provide some key insights to you. In general, Q3 2021 had been a volatile quarter, especially in the month of September. MSCI's global index of world stocks ended the quarter around in a slightly negative position, and it is its first quarterly loss of 2021. US equities delivered a small positive return in Q3, and this is largely down to strong earnings which lifted US stocks in the run-up to August. However, growth and inflation concerns late in the quarter caused US equities to retrace in September. The uncertainty revolving Evergrande has a big impact on Chinese equities and also the emerging markets. Here are some of the key themes that happened in Q3. So market volatility increased due to uncertainty in China. Chinese equities in particular had a difficult quarter following news around Evergrande, and most of us would have heard the most notable event in the third quarter was the crisis that surrounded Chinese property developer Evergrande. And news emerged in September that the company was unable to meet payments on its 300 billion plus of debts and was nearing bankruptcy. Many investors were reminded of the global financial crisis of 2008, which was also triggered by debts in the property sector. Thankfully, the Evergrande fall was not as large, although the news has weighed on Asian stocks during the period. However, the event should serve as a useful reminder of the importance of diversifying your investments. With that, Asia Pacific and emerging market equities underperformed in the last quarter. UK equities had ended the quarter broadly flat. Global equities finished the quarter slightly higher in sterling pound terms, but negative in US dollar terms due to sterling pound weakness against most other major currencies in the last quarter. Commodities gained as Brent crude price continued to trend higher in Q3. And within the fixed income space, global high-yield bonds outperformed investment-grade bonds. The last quarter also saw what's known as a rotation in equity markets. So this happens when investors deem that certain types of companies have become more attractive to invest in than others. We saw this happen last quarter as markets grew more wary of fast-growing companies in sectors such as technology, therefore rotating instead towards so-called value companies in sectors like banking or energy. Of course, markets regularly rotate from one style to another as macroeconomic conditions change. And that is one of the key reasons why we balance investment styles within our fund range, and we do this to improve the consistency of returns and ensure that investment outcomes are not determined by a single investment style being in or out of favor in the market. Now, looking at some of the countries or regions specifically, so for UK equities rose slightly over Q3 as there are some clear sector winners here, such as energy on the back of a recovery in crude oil prices. And the Bank of England took a more hawkish tone due to inflationary pressures as well. This resulted in higher bond yields as the UK 10-year yield increased, and financials typically benefit from increasing interest rate environment like this. Within the Eurozone equities were flat in Q3 with the energy sector being one of the strongest performers. At the same time, large Eurozone countries have now fully vaccinated most of their population against the virus, enabling many restrictions on travel and other activities to be lifted as well. Now back to Asia. Asia ex-Japan equities recorded a negative return in the third quarter, largely driven by the sell-off in China. As mentioned earlier, this was partially due to concerns over the ability of property group Evergrande to service its debt. As a result, the Evergrande situation also sparked global investor concerns over potential spillover risks. Unsurprisingly, China was the worst performing index market in Q3, with sentiment towards the country also weakened by the government's regulatory crackdown affecting the education and technology sectors. Within the Asia-Pacific region, India was the best performing market during the quarter and achieved a strong positive performance due to accommodative monetary policy and the easing of COVID-19 restrictions as well. For the Japanese market, the Japanese equity market traded in a range through July and August before rising in September to deliver a modest return for the quarter. In Japan, Prime Minister Suga announced his intention to resign without contesting the LDP leadership election, and Mr. Kishida was ultimately elected as LDP party. Mr. Kishida typically has a strong view in the vaccination program, which has sustained strong momentum in recent months after the very slow start seen in the first half of the year. And now to US. US equities delivered a small positive return in Q3. Strong earnings had lifted US stocks in the run-up to August, and this is also largely due to the Federal Reserve's slightly dovish tone, confirming its stance to not tighten policy too fast. However, growth and inflation concerns late in the quarter meant that US equities retraced in September. The Federal Reserve also stated in September that tapering of quantitative easing will be announced at the November meeting as expected, and will likely finish by mid-2022. At the same time, the Fed funds rate projections is now showing a faster rate hiking policy than they did in June, and half of the FOMC participants forecast a rate rise next year. The Federal Reserve also sees inflation running to 4.2% this year, above its previous estimate of 3.4%. And in terms of growth in the US, GDP projections were raised for 2022 and 2023 to growth of 3.8% and 2.5% respectively. In summary, inflation numbers, Fed tapering on bond purchases, and the news of Evergrande has grabbed headlines in the last quarter, leading to higher market volatility, especially in September. Now, one of the key topics that was in the headlines last quarter is on the Federal Reserve tapering back on bond purchases, which is likely to happen in the coming months. And this is probably a similar scenario which we had encountered before back in 2013, when we first heard about the term taper tantrum. However, one of the things that which I may highlight here is that the macroeconomic conditions back in 2013 and in 2021 is quite different. For example, in 2013, the unemployment rate is still hovering between 7 to 8%, while the unemployment rate currently is below 5% in the US. The PMI, Purchasing Managers Index numbers, is also looking much more encouraging in 2021 compared to 2013. One thing for sure is that we are likely to continue to hear noises in the market with regards to Fed tapering, as well as future interest rate hikes. This is inevitable, but it does not necessarily mean that it will be bad for the equity markets. Back then, it took around 31 months from the start of taper tantrum in May 2013 for the Fed to increase interest rates for the first time after the global financial crisis as well. As we can see from the chart here, despite monetary tightening policies in the US and in most other countries globally back then, the equity market continued to rally. This is due to the fact that companies are still making very good earnings growth despite the tightening as the overall economy improves. With that, I wanted to emphasize on the importance of staying invested in the market over the longer term, as market volatility will get smoothed out over time. To conclude, I just wanted to share a few key learning points from the last quarter, and that is, firstly, diversification is key to investing. The news on Evergrande is a prime example of what concentration risk may bring. And the second point here is watch the tide, not the waves. There will be continuing noises in the market, and we should not let that distract our long-term investment objectives. And the last point with regards to inflation, equities can be a good hedge against inflation, especially if companies could pass on rising costs to consumers. And that concludes my update for the last quarter this year, and I hope you find it insightful. Thank you.